Hello, everybody. Welcome to History of Money. Professor Barth here, history professor at Arizona State University. We are here, Lecture 31, the Federal Reserve System, Structure and Monetary Policy. Now, I suspect some of the viewers will know most of this information and understand the Federal Reserve already. And I also suspect that many more viewers, maybe even the vast majority of viewers, know little to nothing, or little, maybe next to nothing about the Federal Reserve System. It's a complicated structure, and it is one that is not really easily explainable. Myself, I wasn't a finance major. I was actually a secondary ed teacher. I taught high school for 2 years, and then I got my master's degree and then PhD in history. It wasn't until my early 20s that I even really knew anything at all about the Federal Reserve. And even then, even after that, when I started to become interested in what the Fed is and what it does, and even then, it took me a long time. It's a lot of study before I really felt like I had a good handle on what the Fed does. In this video today, I want to try to crystallize the basic function, the structure, and policy of the Federal Reserve System in layman's terms, in the simplest way possible, without compromising too much the complexities that are very much involved, wrapped up in the system. And I think you'll have a pretty good grasp, fairly good grasp of what the Fed is. And when I say the Fed, that of course is shorthand for the Federal Reserve. So let's begin by looking at the structure of the Federal Reserve System. You'll notice it says system, and it is a system composed of different parts. First of all, we have a Board of Governors. The Board of Governors meet in Washington, D.C., consists of 7 members who serve 14-year-long terms, and those terms are staggered. So a term begins for one governor will begin every 2 years, and their term begins February 1st. So every 2 years, a new term begins, and it's a 14-year-long term. Now, you have a few anomalies like Alan Greenspan, who is part of the Federal Reserve Board of Governors for 19 years. And the reason for that was because he filled a vacancy. And then when that term ran out, he was able to be appointed to a full, proper 14-year term. He was at the Fed between 1987 and 2006. Ordinarily, it's a 14-year-long term, and it's appointed by the U.S. president. Okay, this was a difference between the Aldrich plan, which we talked about in a previous lecture. Appointed by the U.S. president, confirmed by the Senate, staggered terms, 14 years. The president of the United States, then, of that group, appoints the chair and the vice chair. And these are 4-year-long terms for the chair and the vice chair. And the president may reappoint a chair for as long as that member's term is still within this 14-year period. Okay, so a chair can be reappointed. This happened with Ben Bernanke. It happened with Alan Greenspan. And the main charge of the Board of Governors is to oversee the 12 Federal Reserve District banks, and then all 7 members of the Board of Governors serve on the FOMC, the Federal Open Market Committee. But wait on that, okay? First of all, this is where the Board of Governors meet. This is the Eccles Building in Washington, D.C. It was erected in 1937 when Mariner Stoddard Eccles was chairman of the Federal Reserve Board at Washington. And it was actually named the Eccles Building in the early 80s in honor of him. This is where they meet. And this Federal Reserve Board oversees the 12 regional Federal Reserve banks, the district banks. And here are the districts. These have been the districts since the beginning. They're based on 1913 population numbers or distribution. You'll notice District 2 is the most powerful, the wealthiest, the Federal Reserve Bank of New York. Also notice how large District 12 is because the West was less populated in those days. I'm here in Phoenix, so I'm in District 12. Here are the 12 districts. Now, what are these Federal Reserve banks? Well, to begin with the structure of the banks, each bank has a board of directors, and it has 9 members. Now, how are those 9-member board of directors selected? Are they nominated by the U.S. president? No. They are not. 6 of the 9 members are elected by the member banks in that district. So whatever member banks are in that district elect the board of directors. Get to that in a moment. Of those 6 that the member banks elect, 3 of those 6 may represent the interests of those banks. And then the other 3 that the member banks elect are supposed to represent the interests of the public. Okay? How real of a distinction is that really? Between the 3 that represent the public versus the 3 that represent the banking industry? I don't know exactly. One of the reasons why we don't know is because what goes on at the Fed is not completely well known or transparent. But I suspect that it might be close to nominal, if not nominal altogether. Could be wrong about that. But 3 of those 6 are supposed to represent the interests of the public. The other 3 may represent exclusively the interests of those banks. Then the remaining 3 of the 9 members of that board of directors are appointed by the Board of Governors in Washington, D.C. All right? And of course, the Board of Governors is appointed by the U.S. President. So you have an indirect link there, but no government appointees here. And then the Board of Directors nominate the president of that bank. It used to be called governor. Now it's called the president of that bank, which is essentially the chief executive officer of that Federal Reserve Bank. The Board of Governors in Washington, D.C. then must approve that nomination. Now, on this question of member banks, what is a member bank? Member banks are private commercial institutions, all right? Commercial banks, could be credit unions, any sort of private commercial depository institution that owns stock in the Federal Reserve Bank in their district, okay? Member banks in that district own stock in the Federal Reserve Bank, and to be a member bank, to be a member of the Federal Reserve System, you must own stock equal to 3% of your combined capital and surplus at that bank. So 3% of your capital, that's how much stock you must own in your Federal Reserve Bank. But this is not stock in the sense that we think of stock being traded in the New York Stock Exchange. The stock is non-transferable, can't be sold, it can't be traded. All right? Member banks automatically receive, they are entitled to, an annual dividend on that stock of 6%. Not a bad dividend. 6% you are entitled to, 6% dividend on the stock you own in the Federal Reserve Bank. And then any profits at that Federal Reserve Bank that exceed 6% go automatically to the U.S. Treasury. Okay? That's the deal that was worked out. So, for example, in 2015, the Federal Reserve System, all the 12 banks, collectively made a profit of, get this, $100 billion. $100 billion. Of that, $2.5 billion was distributed as dividends to member banks, and then $97 billion was distributed to the U.S. Treasury. So that's a lot of money to the U.S. Treasury. Actually, 2015 was a record year for the profits made by the Federal Reserve System. But still, $2.5 billion distributed to member banks. That's not a small amount either. But those were the dividends. Now, what are these banks exactly? Are they private? Are they public? Well, I'll tell you what, they're definitely not public. They're not public. They're not considered public. In fact, actually, the courts have ruled on the nature of these Federal Reserve banks. Not the Federal Reserve Board, but the Federal Reserve banks. There's a case, Lewis versus the United States in 1982. Without going into details of that case, the court concluded that the 12 Federal Reserve banks are, quote, independent, privately owned, and locally controlled corporations. Nevertheless, this is where the nuances comes in, they have properly been held to be federal instrumentalities for some purposes. An instrumentality, that is often how these are described. These Federal Reserve banks were federally created. Many of their profits actually go to the U.S. Treasury, and yet the stock is privately owned. They act completely independently, not within the Federal Reserve System, but independently of government, of any government accountability or anything of that nature. They are tax exempt. And so it's a strange thing. Here's another case in 2005, Scott versus Federal Reserve Bank of New York City. The court made a distinction between the Board of Governors, which is called a federal agency, and even this has some problems. A federal agency, but the Federal Reserve banks, again, are federally created instrumentalities. There are restrictions, though, again, that a purely private corporation doesn't face. For example, the member banks at the Federal Reserve cannot come together as the stockholders at that Federal Reserve Bank and change its charter or change its structure like any other corporation has the right to do. And again, they can't transfer their stock and have to give surplus dividends away to the U.S. Treasury. But they are essentially private institutions. And they have a lot of assets. So I mentioned the profits that were made. What about their assets? Well, this is the current. I looked it up yesterday, actually, to get the most updated numbers. This is November 2020. The collective assets of the 12 Federal Reserve banks amount to $7.15 trillion. That's a lot of money. Now, of those banks, the wealthiest is the Federal Reserve Bank of New York, and this is always the case. The Federal Reserve Bank of New York has always been the wealthiest of the 12 banks. And they have, as of November 2020, close to $4 trillion of assets. Absolutely incredible. And then the Federal Reserve Bank of San Francisco is second place, and they have $725 billion of assets, and then it goes down from there with the other district banks. And actually, the assets of the Federal Reserve System have gone through the roof just this year alone after the coronavirus, the eruption of that whole thing back in March. Here's a graph from the Federal Reserve Bank of St. Louis. They provide a lot of good statistical graphs on their site. These are assets of the Federal Reserve banks collectively. And look at, it's hovered around $1 trillion, actually just shy of $1 trillion for all of the Federal Reserve banks before 2008. Okay, now it's over $7 trillion. Okay, so before 2008, the collective assets of the Federal Reserve banks were under $1 trillion. Then there was a big jump in 2009, and you're talking about $3 to $4 trillion. The balance sheet really went up, and then it's hovering around $4 trillion, $4 to $5 trillion, and then look at that, just huge spike in March of 2020, where it went from under $5 trillion now to over $7 trillion of assets. The Fed, in response to coronavirus, eliminated reserve balance requirements and made huge asset purchases in order to shore up the markets. Be interesting to see what the consequences of that will be in the near future. More on the Fed's response to coronavirus in a moment. And then the other element of the Federal Reserve System, the Federal Open Market Committee, or FOMC. Okay, so you had the Board of Governors, appointed by the President, sit in Washington, D.C., oversee the system. Then you have the 12 district banks, privately held, privately owned, with restrictions on what they can and can't do. And then you have the FOMC. Now, the FOMC was not created until 1933. Okay? Before 1933, each district bank, each of the 12 private banks, conducted their own independent autonomous monetary policy. But in 1933, there was a banking reform, and this created the FOMC. Now, initially, the FOMC just consisted of all 12 district presidents of the Federal Reserve banks. Then in 1935, the composition was changed to its current structure. The FOMC includes all 7 members of the Board of Governors. Remember, it's a committee. All 7 members of the Board of Governors. It includes the president of the New York Fed. So the president of the New York Fed always sits on the FOMC. And then the remaining 4 members are a rotation of the other 12 district presidents. Rotation of 4 of the 12, or of the 11, because the New York Fed always sits on the FOMC. A rotation of the remaining 11, 4 of the remaining 11 district presidents. They meet 8 times a year in Washington, D.C., at the Eccles Building. Usually the meetings are about 7 weeks apart. And at these meetings, they deliberate and determine basically Fed monetary policy. What is the Fed's monetary policy? And this, one of the chief aims here, one of the chief things that they do in the FOMC meetings is they set target rates, the federal funds target rate. Get to that in a second, okay? But that's the FOMC, so that's the other element of the Federal Reserve System. You could add another element. There's a council called the Federal Advisory Council that consists of 12 members of the 12 representatives of the banking industry, and the Federal Advisory Council will confer with the Board of Governors and the FOMC, and so that's another element. But this is the basic structure, okay? Here's a meeting of the FOMC. Of course, there are other people present here than just the Board of Governors and the New York Fed president and 4 other district presidents. But there's a meeting, Ben Bernanke. So this was during Bernanke's term as Fed chair. Whew. All right. Does that kind of make sense? Yeah. I told you it's confusing. It's a little confusing. Now, what the heck does the FOMC do? Okay, because that's our big question here. All right. The FOMC is in charge of, well, it's Federal Open Market Committee. Well, what does that mean? And what is this target rate that they set? Well, the Federal Reserve conducts monetary policy through what are called open market operations. Open market operations. But what they do initially at the FOMC is they set a target for the federal funds rate. Now, what is the federal funds rate, or the Fed funds rate? The federal funds rate is the interest rate at which member banks borrow money overnight from other member banks at the Fed in order to retain the minimum reserve balance that they need on deposit at the Fed. So, if you have excess reserves at the Fed, because there's each member bank has to keep. Let me rewind. Each member bank has to keep minimum reserve balance at the Fed. Right? It's varied depending on the year. Actually, right now it's zero since the coronavirus, but ordinarily, depending on the size of the institution, it can be anywhere from 3 to 10%. And you keep these reserve balances at the Fed. And then if you exceeded the requirement, there's an incentive to lend to other member banks who need to meet their reserve requirement. Okay, and the member bank loaning money to another member bank will charge an interest rate, and that interest rate they negotiate. Okay, that's a negotiated interest rate. Well, the FOMC exists to try to set what that interest rate is going to be. So they come up with a target rate, and usually it's a range. Right now, the target rate is extraordinarily low. It's 0 to 0.25%. Okay, and so the Fed is aiming for this federal funds rate to be somewhere between 0 and 0.25%. Now, how does the FOMC, the Federal Reserve, influence this interest rate? Okay, they do it through open market operations. But before that, I'm getting too far ahead of myself. I told you this stuff's a little complicated. When the federal funds rate is falling, when it's going down, okay, as it did in March of 2020, dramatically, we'll see a graph here in a second. When the rate is falling, when the interest rate is falling, which member banks borrow from one another at the Fed, what that essentially is a benchmark. It tells you something about the currency supply and the supply of credit in the economy. That means essentially you have an expansion of credit and currency. Okay, so a lower interest rate equals more credit, more currency available. Okay, when the rate is rising, when it's going up, what that means is credit and currency is being drawn back in. There's a contraction. Okay, it might be slow, it might be more rapid, depending on the period. There are periods of Fed history where it was a rapid rise in the interest rate and a pretty severe contraction in the supply of credit and of currency. So that's what this means. It's a huge number, a huge figure in the U.S. economy, this federal funds rate. All right, there we go. The FOMC sets the target federal funds rate. So they say, right now it's 0 to 0.25. Okay, so not too long ago it was 1.5 to 1.75. And the way they influence what is the actual federal funds rate, because remember the federal funds, these member banks, they negotiate what the interest rate is. Okay, it's not dictated to them by the Federal Reserve. They negotiate what the interest rate is, and so the Federal Reserve wants to influence it. The target rate is the range at which they would like to see that interest rate be, and then the actual interest rate, which is the weighted average of all these negotiated deals between member banks, that's called the federal funds effective rate. That's the actual effective rate currently, this weighted average at which member banks borrow from one another at the Fed. So in order to influence the federal funds effective rate to meet the target, the Fed will use what's called open market operations. It has other tools in its chest, but for our purposes here, I want to focus on the open market operations. What does this mean? This means that the Fed will act in the market and will either buy or sell securities, usually government bonds, usually treasury bonds, but it can be any sort of security. It can be mortgage bonds. It can be all sorts of different securities. They'll either buy or sell those securities with primary dealers who have accounts with depository institutions at the Federal Reserve, with those member banks. Okay, so if the Federal Reserve wants to cause the federal funds rate to go down, what they do is they will buy securities, treasury bonds, whatever. They will purchase securities, buy securities, and then in purchasing that, deposit funds in that primary dealer's account at that member bank. Okay, so they'll deposit the funds in that member bank, in that member bank's account at the Fed, essentially increasing their reserve balance. Okay, so the Fed purchases these securities, that increases the reserve balance of the member bank. Now that they have greater reserves and they're at the Fed, they can, they're more willing to lend to other depository institutions, to other member banks, which causes the effective federal funds rate to fall. Now, when the Fed purchases these securities, what they'll do most of the time, they don't always just print money and give it to the bank. It doesn't work quite like that, although sometimes it does effectively. But more often than not, they just digitally add it. They'll add a zero to a bank's account at the Fed. Okay, it's just kind of digitally created. Add a zero to the bank's account. Then, if the bank wants to have new Federal Reserve notes, they can decrease their reserve balance at the Federal Reserve, and that's when the Federal Reserve will give them actual Federal Reserve notes. So that's if the Fed wants to influence the target rate in a downward direction. Now, let's say the Federal Reserve later decides it wants to raise the federal funds rate. How do you raise the federal funds rate? How do you cause the rate to go up? Well, instead of purchasing securities and depositing funds in member banks' account, the Fed will sell securities, sell its assets that it has at the Federal Reserve Bank, sell it, and then primary dealers will buy those securities from the Fed, and then the Fed will get money for that sale by withdrawing funds from the member bank's account. Okay, withdrawing funds from the member bank's account, which will diminish their reserve balance at the Fed, and thus will make the federal funds rate, the effective rate, go up because there's less money available to lend to other banks at the Fed. I told y'all this is a little confusing. Does this make sense? Man, I said I was going to try to do it in layman's terms. Maybe maybe that's not quite possible. I hope this makes somewhat sense. And no, actually, it's way more complicated than even this. I'm giving you the just fundamentals here. Okay, you could spend a lifetime studying what goes on at the Fed. These are elementary principles here. So, open market operations, in short, Fed increases the money supply either by digitally or sometimes by printing new notes, putting new notes into circulation. Increases the money supply by purchasing securities. The Fed decreases the money supply by selling securities. Okay? And then sucking that money back into the Fed. Okay? Thus decreasing the money supply, thus increasing the federal funds rate. Okay? That's open market operations. Now, this is important. Open market operations are not subject to any federal audit. They are not subject to any government audit. So we don't know exactly all that goes on. We don't know about what purchases are made, at what price, from which dealer. None of that is subject to audit. It's all undercover, okay? There are many people who would like to change that and who would like to introduce more transparency at the Fed. The Fed greatly opposes that. Putting my cards on the table, I fully support an audit of the Federal Reserve. I think the American people have a right to know what the Federal Reserve does in its dealings. And not just buying and selling securities in the open market, but also its transactions with foreign central banks and other entities. But as of November 2020, these are not subject to audit, nor are any of the proceedings or deliberations of the FOMC. So that's all done secretly, and there are real concerns about that and about what goes on at the Fed. I might make another video about that at some future date. Okay, here's a chart of the effective federal funds rate. So not the target rate, but the actual weighted average of effective federal funds rate through the years. So that's 1955. And you'll see, just by the way, the shaded areas are periods of economic downturn. You'll notice rates were going up in the 1960s and a big turn downward. Then in the 70s, chaos. We'll get to that in a later lecture, but that was during all the inflation of the 1970s. And then to arrest the inflation, the Fed spiked rates. Look at this. Had to peak at 18%. Wow. But it was necessary. It was necessary because inflation was going out of control. That was under Paul Volcker, chairman of the Fed. Made some really tough decisions there. But huge spike in the federal funds rate. And look at that. Since then, it's been going down, 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 down. Quite low after the dot-com crash. This fueled a housing bubble. And rates started to go up again around 2006. And then after 2009, like zero. This was unprecedented in Fed history. Then around 2016, it started to go up again. And then coronavirus did away with that. And so now we're back down to zero. This is the effective rate. This is the target range. Okay. And this represents the upper limit. So the target is it's always a range. Right now it's 0 to 0.25%. So you hear the upper limit is 0.25%. Yeah, look at this. It was 0.25% after 2009. This, again, unprecedented period. And then the Fed kind of cautiously moved it up. Usually the Fed never... It's very rare that the Fed will move more than a quarter. Okay, we're definitely not more than half a percentage point. That's quite rare, but you can see going up, up, up. President Trump was not happy about this, by the way. Got into quite a bit of a public scuffle with the Fed chair, Jerome Powell, over this. There was a question, will Trump remove Jerome Powell for raising interest rates? Even then, it was still only 2.5%. That's pretty dang low historically. Look at that. I mean, that wasn't that high. But Trump did not like that. Presidents do have, and Congresses have an interest in low interest rates because temporarily it helps the economy supposedly, but it can have consequences. Can have quite severe consequences. But yeah, look at that. Look at that drop. That's in March of 2020. Just plunge. Very, very unusual, atypical move by the FOMC in response to the coronavirus. And now we're back down here. That was a huge jump. My wife and I actually refinanced our house. Saved a lot of money. Saving $400 a month because of that refinance. Yes, not bad. But I don't like this. But it is what it is. Now, what the heck does this have to do with me? Why should I care about this? Who cares? Well, first of all, the federal funds rate has an enormous impact on the economy. All right, and again, I already mentioned how it affects the supply of currency and credit. Okay, when rates are going down, currency and credit expands. When rates are going up, currency and credit contracts a bit. That has an impact on you. One way in which it has an impact is on what's called the prime rate. The prime rate. This is the interest rate used by the banks for lending to ordinary customers, clients, and businesses. All right, so this is the rate that you, the American, can borrow money, and this is tied very, very closely to the federal funds rate. Usually, it's about 3% higher. Okay, 3% higher. So the banks borrow at this lower rate, and then they'll lend you the money at the higher rate. You can debate on the ethics of that, perhaps, but the rate at which you can borrow money is heavily influenced by that. So, like the example I gave, we refinanced our house. I'm saving $400 a month now because of that lower rate. It influenced the mortgage markets. So this is a graph of bank prime loan rates historically since the mid-1950s. Look at that. It's basically identical. We're close. It's just a few percentage points higher. So like in the early 80s, for you to borrow money, it was over 20% interest. Okay? Because lending was becoming so scarce. The available money for lending was so scarce because we had to stop the inflation. So compare this is the prime rate graph, to this. This is a federal funds graph. See how closely tied they are. It's basically the same graph. Okay? It's pretty remarkable, actually. So it has a huge impact. A huge impact. The Federal Reserve actually exercises far more power over the U.S. economy than Congress or the president. It just does. It just does. That's the fact of the matter. Now, presidents and Congresses, they do make a difference. Tax policy, regulatory policy, that really does matter in the economy. So I'm not saying that stuff doesn't matter. But this right here, we're talking about just the absolute foundation of the U.S. economy, credit, okay? And the Federal Reserve is in charge of that. One last element to Federal Reserve monetary policy. There is also another option for member banks. It's called the discount window. And the discount window is if you're in need of funds, and especially in an emergency, the discount window is considered the last instrument, sort of the last bulwark in case of a financial crisis. You can borrow money directly from the Fed itself instead of from other member banks. Okay, if for whatever reason, in a time of crisis, you can't do it. So you could go to discount window, borrow money directly from the Fed. This is called the discount rate. Usually the discount rate is about 1% higher than the federal funds rate. So if you don't have to use it, you don't. And there is a stigma attached to it. There's a stigma attached to it. And so you generally, banks don't like this as much, but that is available. And lending at the discount window also, by the way, is not audited by the government, just like open market operations or FOMC proceedings. But that's there as well. Now, the Federal Reserve considers itself independent within the government, okay? But Federal Reserve independence, you hear about a lot, the independence of the Federal Reserve. You hear about it sometimes or a lot of times with the judiciary. We need an independent judiciary. What does that mean? Judges can make decisions and not have to worry about the political consequences. They can just judge and not have to, be concerned themselves about re-election or anything like that. The independent judiciary. Well, in a similar manner, the Fed celebrates this idea of Federal Reserve independence. What does this mean, their independence? Well, as I already mentioned, the FOMC, their actions, their transactions, their buying and selling of different securities and assets, and their deliberations are not subject to any government audit. All right, I already spoke about that, but I support a full audit personally. I think not having an audit actually is quite indefensible in a system like ours, a democratic republic. Nonetheless, the Federal Reserve defends this avoidance of any audit by saying, well, we need to guard our independence. We need to be able to deliberate as a committee and to make tough decisions in the open market without having to worry about political consequences if a certain purchase or sale might look bad or whatever. All right, we need to be able to act independently without having that in the back of our mind. That's the defense of that the Fed puts forward in opposing an audit. The Federal Reserve fiercely opposes an audit of its actions, and that is the reason that they cite. But that's not the only element of Fed independence. Monetary policy decisions do not have to be approved by the Congress. They do not have to be approved by the President or by any federal department. They act completely independently. Now, the President of the United States technically can remove a member of the Board of Governors, but it's seen as like very, very big no-no. Okay, even when Trump toyed with the idea of maybe doing something with Powell, right? The media was howling. Can't do that. I need to preserve Fed independence. And so, technically, according to law, the president can remove a member of the Board of Governors for cause, but it's ill-defined and it's not really used. So monetary policy decisions do not have to be approved at all by any member of the government. Also, the Fed does not receive any funding from the Congress, okay? So all other agencies, the military, every part of the federal government receives funds appropriated to it by the Congress. The Federal Reserve is the exception. Federal Reserve does not receive any funding from the Congress. This protects it from Congress because one of the tools that Congress has is the power of the purse. If Congress wants, they can pull funding from an agency they don't like or an agency who maybe is acting up. Not so with the Fed. The Fed is independent of any appropriations from the Congress. And then, lastly, first of all, the board of directors at the 12 regional banks are not responsible at all. They're elected by the banking industry, 6 of the 9, and then 3 of the 9 by the Board of Governors. But members of the Board of Governors in D.C., with 14-year terms, that spans multiple presidents and multiple Congresses and gives them, it's not a life term like a Supreme Court judge, but it still gives them a measure of independence from partisan feeling or whatever. So, that's that. And there are the notes today. Those are the notes today. By the way, the Treasury Department, the Bureau of Engraving and Printing, which is a bureau of the Department of the Treasury, they're the ones who design the notes, print the notes. That's the only role that the Treasury Department plays in all of this. But it doesn't say the United States of America will pay to the bearer on demand $5 anymore. It just says this note is legal tender for all debts, public and private. Period. Federal Reserve note, $5 bill. But the signature there, Secretary of the Treasury, Treasurer of the United States, and that's placed there because the Bureau of Engraving and Printing are the ones who design these notes and print them. $5 note, $10 note, $20. The $100 note got anti-counterfeiting measures placed on all these notes, but especially the 100. Notes in poor condition are destroyed, and then replacements are ordered from the Bureau of Engraving and Printing. I have here that about 7,000 tons of worn out currency are destroyed every year. 7,000 tons. The average length of circulation for a $1 bill or a $5 bill is only 5 to 6 years. Average length of circulation for a $10 note is around 5 years. $20 note about 8 years. $100 note about 15 years. So when they get old and ragged, destroy the notes and replacements are ordered. That's today. For the next lecture, we're gonna go back, all right, and we'll enter the World War I era, and then the 1920s. So this was the note in 1914. I think this is, a series of 1914. Federal Reserve note, United States of America, will pay to the bearer on demand $20 in gold. So we're going to go back to that mindset. But I hope that this lecture made sense. There's the signing of the Wilson signing the Federal Reserve Act on December 23rd, 1913. Federal Reserve Board. New York Fed, headed by Benjamin Strong Jr., Morgan Man, Bankers Trust of New York. And that's where we will pick up next time. So thanks for watching, and I look forward to continuing onward into the 20th century. See you later. Bye.